Let's start with the markets, as we always do here on this show. Of course, the S&P 500 set to rise fractionally, a jobs report very much in focus. And joining me now with more is Joe Brusuelas. He's a chief economist at RSM US. Joe, it's great to see you.
Good to see you too.
A lot to talk about today. So let's start with where we are in the markets and what the economy is telling us.
Well, right now we've got a move upward in global bond yields. I think that there's been a general reassessment on the part of central banks' willingness to tolerate higher inflation. And so you're seeing Germany, France, Great Britain, Japan, and the US all see long-dated yields move higher, even as shorter-term paper has fallen over the last couple months.
Yeah, and how does that impact the Fed's decision, perhaps? What does that maybe portend about the decision that we'll get from the Fed in September?
Well, you know, a lot's riding on the jobs payroll report this Friday. The Fed and the other central banks look like they've shifted into, they're much more worried about growth mode. They're worried about keeping unemployment, or the unemployment rate stable, and wanting to see how we evolve over the next 6 months with respect to just how many jobs we need to produce each month to keep employment conditions stable. Because we've got a lot of people retiring, about 11,000 a day. We've got some pretty serious and substantial immigration policy that's going to alter the supply of workers entering the market. That looks to me as like we need to produce about 50,000 per month. That's it. To keep labor market conditions stable. Now, there are some out there, including people out of the administration, saying, you know, that may be negative, a negative number. Now, that's a place we just haven't been, and it makes it more difficult for the Fed to make monetary policy decisions about where we'll be going with, say, inflation. Will we have second-round wage push inflation because we don't have enough workers, which will restore bargaining power back to workers, perhaps like we saw during the pandemic. This is getting infinitely complex as we move forward.
Yeah, so let's talk about that jobs report on Friday. This will be the August payrolls number. Consensus seems to be at about 75,000 jobs created. Where do you fall?
All right, so in the second half of the year, our forecast was we would produce about 80,000 per month. So we're not deviating from that. In July, we got to 73,000. You know, in the August payroll report over the last several years, there's been a seasonal downward bias in the report, so I think there's a bit of risk to the downside. I'm expecting a modest increase in the unemployment rate to 4.3%. Wages should come in about 0.3% on the month, which should translate to 3.8, 3.9 on a year-ago basis. But when we dig into the report, obviously, we're going to be looking for two things. We're going to see if almost all of the jobs created are in healthcare and private education. If that's the case, you'll see a rate cut when we meet on September 17th. Now, if we get a number that's to the upside, and you see a reacceleration in hiring, especially across the private business landscape, places like finance, places like retail, well, then we're going to be waiting on those inflation reports, and the Fed will just have a very difficult decision to make. My sense is we get the rate cut, though, at this point.
25 basis points?
That's it, 25 basis points, yeah. But it might be one and done, though. That's the thing. We'll have to see how inflation evolves. So I want to tell you, inflation is moving in the wrong direction right now. I run 4 different models to estimate the optimal interest rate. Not one is suggesting that it's time to cut rates. So we really are at a potential inflection point here, and that's why those bond yields are going up, because investors basically are deciding the Fed's probably willing to tolerate inflation between 3% and 4% over the next few years.
Interesting. And is that what the models show, that you anticipate 3 to 4% inflation for the next few years?
Well, the models are showing a couple things. First, in terms of the optimal interest rate, I only have one that's suggesting that we should just be patient. There are 2 that are suggesting, hey guys, we're going to have higher inflation. We may need to think about hiking rates. In terms of our models estimating inflation, yeah, we got them going above 3% here. The CPI and the PCE by early next year are all going to be above 3%, perhaps even by the end of the year. That's just not a place I think where monetary policymakers just want to be.
How do tariffs factor into this?
So tariffs have begun to show up in the hard data. If you look at goods inflation, well, just 6 months ago, we were still in deflation mode. No, that's changed. Goods inflation's moving higher. You know what the problem, Kristen, though, is? It's the stubborn and sticky inflation in the service sector that's really causing some heartburn over at the Federal Reserve. Because that's why we've had a real problem moving down to just where we're at now. It does look like we're just not going to get back to 2% anytime soon.
Interesting. And so when we look at the economy as a whole, Joe, what are you projecting for GDP growth?
All right, so we're thinking 1.1% for this year. And then you get a reacceleration next year on the back of the tax cuts. I'm very bullish on how the economy is going to respond to the ability of firms to write off capital investment retroactively to this year. So I'm expecting that to really take off in the final 3 months of the year and then accelerate through early next year. Next year, I'm thinking, in that 2 to 2.5% GDP growth. But I got to tell you, the uncertainty due to trade policy is really putting a constraint on overall activity. We're just not seeing the economy grow the way we want to be, right? And if we do begin to reaccelerate, it's very important that we iron out policy because it's just all over the place. And that's a real problem. We've got an internal survey that we run each quarter. It's our Middle Market Business Index. For the third quarter, 2/3 of our survey respondents told us that they were paying higher prices for their key inputs, whether they be intermediate or earlier stages of production. But only 48% of them are able to pass through the prices. There's a fundamental imbalance there that suggests if we don't iron this out, thinner profit margins lie ahead, and that'll happen regardless of how well the economy is doing.
Joe Brusuelas in studio with me breaking down the economy. He's the chief economist at RSM US. Joe, thank you as always.